So if the first biggest mistake people make is selling their winners, the second biggest mistake they make is not selling their losers. You should get rid of losing positions. And it's not just because they might keep going down, which they might. No, the reason is because when you sell a loser, you get the IRS to share your pain. You get to write it off. You take a capital loss. You buy something for $100, it goes to $60, you got a $40 capital loss. And it's nice to have capital losses, well, to report on your tax return. You don't want to have stocks that go down, but they do sometimes go down. And when they do, you want the IRS to share your pain. So what do you do with a capital loss? Let's make it a little bigger than $40. Let's be realistic. You lost a couple $1,000s. One of the things you can do with a capital loss is to use it to absorb other income. You can write off your capital losses at a rate of $3,000 a year against things like your salary. Now again, I'm not trying to lose money. I'm trying to make money. But when I do have a stinker, I do want to be able to sell it, take the capital loss, have the IRS share the pain, and a $3,000 deduction against my salary, depending on what state I'm living in, is easily going to be worth $1,000. What do you do with losses bigger than $3,000? There's something else you can do. You can have a capital loss carry forward. Let's just suppose you lose $10,000 on the Apple stock that instead of going up went down. $10,000. You take $3,000 off this year, $7,000 gets carried forward. You can use that next year. You can use another $3,000 the year after that. Suddenly your $10,000 of pain isn't so painful because you're getting the tax collector to share it with you. You might have some gains somewhere that you can't avoid taking. For example, you decide to move. You use up your house exemption and you still got a capital gain left. You might have $50,000. You might have $100,000 you want to shelter. Having a capital loss carry forward is not a bad idea. It'll absorb some of that gain. It could save you a lot of money. You don't want to be buying high and selling low. That's the way to get poor. You don't want to be whipsawed. You don't want to buy Apple at $600, sell it at $400 to get your $200 deduction, and then watch it go right back up to $600. So what do you do about that? What you should do is reinvest when you're selling after a bear market in other stocks. Not exactly the same ones, but similar stocks, and help those come back up. That way, if the market goes down and then rebounds, you're back where you started except for one little thing. You're telling the IRS you're poor. You're telling the IRS you lost $200. In fact, you may be breaking even, or you could even be making a mint. Why? Because you're not selling your winners. You're just selling your losers. You're reinvesting. You're avoiding buy high and sell low, but you're claiming tax deductions. I like tax deductions.